Well, hey there, everyone. Happy Tuesday, March 10th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. Great to be with you here live, sharing some charts, some insights, and some observations here on a Tuesday afternoon. We're coming to you from a kind of beautifully overcast, not too wet, kind of dry Redmond, Washington winter day. Hope you guys are all doing well, staying happy, staying safe wherever you're tuning in from. We are live streaming on Facebook, LinkedIn, YouTube, and X. Appreciate you, those of you joining us live. Great to have you here on any of those platforms. You can drop questions or comments all along the live stream in the comments section of those sites. I can see them all here on the live stream platform. As we go, I'll try to take some random questions along the way, but some of our finest questions I'll be saving for our Friday mailbag episode. Those episodes always are a lot of fun because it gives me a little more time to provide some thoughtful responses and charts to back it up. So I appreciate at any point drop your questions in the chat and look forward to hearing from you. Interesting day today. The S&P stealing defeat from the jaws of victory earlier in the day, kind of early afternoon. Things felt pretty good. It felt like a nice continuation to the strength that we saw on Monday's section coming out of this, kind of rough weekend news-wise. Monday opened and showed quite a bit of strength. So yesterday we're talking about the resilient nature of the markets, these bullish engulfing patterns. We did see a pop higher in a lot of those charts that feature those bullish engulfing patterns. So big thumbs up to candlestick analysis still working here in 2026. So that's good. But what was interesting, I think, was the afternoon, where the S&P and the NASDAQ started to rotate lower. You're going to note that technology was basically a rounding error, but pretty much all of the sectors were down today. The breadth was not particularly strong, continuing one of those, evolutions we've seen as 2026 has progressed. Today, we're going to talk about a couple things in particular, but one thing that I wanted to highlight for you is how the equal weighted S&P has started to come down. And when you think about what's changed from from February to March, and I know we're only a week and a half into to this new month, the equal weighted S&P has gone from trending higher to trending lower. The advanced decline line for the New York Stock Exchange has gone from trending higher to trending lower. Still early. It's not like a horrible chart, but it's definitely changed. We've had a bit of a change of character. And I think picking up on those subtle changes in market conditions in a lot of ways is the game. I think that's so valuable. So I'll share with you some of those charts and some insights along the way. Shall we get started? If you're new to the show, thank you so much for watching. We have the show broken up into three sections. First off, we'll get you updated on what happened in the market today. If you've been distracted doing other things, I don't know, doing a full-time job, whatever it is that you do when you're not watching Chart This with Dave Keller, we'll get you up to speed on the most important movements you should be aware of. We'll then look at the heat map and focus on group, sector, and individual stock themes where we're seeing potential movements to be aware of. And then I've hand-selected some charts through the course of the day that I'll share with you here. Kicking things off here, I mentioned sort of the afternoon session looking weaker, and you can see the S&P was teasing 6850 right after lunch Eastern time, but the afternoon was pretty rough. The S&P closed back below 6,800. That 6,800 level ending up being a pretty meaningful level. Yesterday, we talked about how we had regained that 6,800 point. We closed right up to that point. That's interesting because that was our initial line in the sand. And what we talked about kind of last week was once we had that breakdown on Friday, worst case scenario here is a rally back up to 6,800, which we've now done. And then that resets the next big leg lower, right? We break down below support. Support becomes resistance, kind of further validating that as a pivot point. That's in the back of my mind, particularly today as we close back below that 6,800 pivot point. That's an important level to watch. And as we mentioned yesterday, do we get a foothold above 6,800? The answer so far after today's session is no, we have not done so. So the S&P down about 0.25% to 6781 and change. The Dow was flat. The NASDAQ was flat. This was not a big volatile day for the most part in terms of the end result at the end of the session. Mid caps and small caps lagged behind. Small caps have been lagging behind here and down another 0.5% relative to the S&P and the NASDAQ, kind of flat to slightly lower. The VIX did move slightly lower as well. It sort of surged higher in the afternoon. Midday, it was down around 22.5, but going into the close, spike up to around 25. So volatility is still there. The VIX is still above 20. That tells us we're still in a high volatility environment. Tells me basically we are showing conditions similar to major peaks in markets in cycles past. So that tells me to be cautious, which is how I would describe my mood right about now as a market practitioner. Interest rates, kind of an interesting day, to be honest with you. The TLT ended up going lower. So while stocks were basically flat today, basically by mid-afternoon, the S&P was up. Bonds had opened lower, but were kind of holding steady. And then in the afternoon, the S&P went net negative, and you can see that the TLT, which is a bond ETF, actually rotated lower as well. So both bonds and stocks had a rough afternoon, sort of cementing a down day, a day in red for both of those. You see the TLT finishing down about 1.1%. The 10-year yield was essentially flat. That was only after bonds sold off in the afternoon and kind of took it back to Monday's close. So the 10-year yield holding steady right just above 4.1%. The long bond yield's around just below 4.8%. Dollar was flat today, so no real issue there. Gold and silver, sort of holding in there. Both of those charts, I would say, in the short term, very noisy, very choppy. In the medium term and long term, quite healthy. These are good charts that are remaining in a position of strength, I would argue, at this point. The GLD and the SLV both finishing in the green. Very important to note relative to the S&P 500 that was flat, slightly down going into the close. Crude oil prices, noisy, volatile. That is how I would describe the conditions with crude oil prices. And one of the issues is as we all feel like it's a great thing that we have like instantaneous news flow, and that someone, a department secretary can tweet something out. It turns out there was a tweet that went out from, I think, the energy secretary that a U.S. ship had chaperoned an oil tanker through the Strait of Hormuz. It turns out that was not true, and it was ended up taking down. But as a result, the market moved very quickly in reaction to that tweet that ended up not actually being true. So the good news is we've got instant information. The bad news is we have instant information, and so it's not instantaneous access to absolutely accurate and well-researched information. It's just sort of whatever anyone vomits up, and there's no barrier to entry. So we take the good with the bad. We can't be immediately informed and have it be thoroughly researched and vetted. So we're opting for instantaneous, which means we have to take anything we see and hear with a great amount of caution. Having said that, crude oil had a pretty volatile session. The USO was basically flat for the day, up slightly, right? It's showing the USO is up 1.5%. This is a pretty wide percentage swings that you're seeing, even though it looks like a little move. This is a big range from $95 up to $125 for the USO over the last couple sessions. So volatile time series for sure. Looking at the crypto markets, all pretty good here. Bitcoin is currently trading just above 70,000. Regaining that 70,000 level is a line in the sand we've been talking about. We did grab the chart of Bitcoin just to apply a quick Fibonacci framework, give you a sense of if we do break above 70,000, which we're maybe starting to do, what some additional levels of resistance we might expect. Overall, I'm not really in Bitcoin at this moment. I'm sort of waiting for further improvement. Sort of holding its ground. It's making some short-term higher lows. That's not a bad thing. But is it enough to start to be optimistic about? That's where I'm still on the fence between you and I here on the show. All right. Looking at the 11 S&P sectors, technology, no kidding. According to stock charts, the XLK was unchanged. I'm talking exactly $0.00 and cents from Monday's close to Tuesday's close. It doesn't happen often that you get an absolute unchanged. That happened a lot back when things were traded on 8s. You would get unchanged quotes a lot. You don't these days with things trading at sub-penny levels. But here we are. The XLK listed as flat, literally flat. Everything else was down today. So along with technology, you had consumer discretionary, real estate, communication services. These were all down less than 0.25%. So essentially flat for the day. On the downside, you can see energy feeling the pain of that choppy oil price series, feeling, oil is going to be a volatile series here for a little while, certainly as events in the Middle East continue to be volatile as well. Having said that, energy stocks have had pretty incredible runs. A lot of those charts are still in positions of strength, but showing some choppiness here over the last week, understandably so. The XLE was down 1.3% today. Healthcare, utilities, both down over 0.5%, less than 1%. Not a huge, big movement day when you look at the sectors, but way more down than up. As a matter of fact, none of them technically up for the day. Kind of an interesting breadth reading. When I see a table like this, I'm immediately skeptical on the data. And friends at Stock Charts, I'm not questioning our data sources here, but this looks weird to me. The New York Composite Index, 53% down to 45% up. About the same for the NASDAQ Composite, 48 to 48%. But then you look at the S&P 500, and 70% of the S&P was down today versus 30% up. I guess this math could technically work out, but it seems strange to me that the S&P large cap, mid cap, and small cap indexes all weak in terms of breadth data. Way more in a bearish situation with 70-ish% of the S&P 500 down, whereas only 53% of the New York Composite Index down. That technically could happen, but it would be kind of weird. So breadth looks, kind of neutral to pretty bearish, depending on which particular index we're reviewing right about now. That rotation, by the way, from strong breadth to weaker breadth, I was on the Money Shows doing a virtual expo today and tomorrow, really focusing on alternative assets like real estate and private equity and other things. But I was on there first thing this morning doing a session just talking about market observations and conditions here to sort of set the table for the meal over today and tomorrow. That podcast with Mike Larson should be posted here in the next couple days. And I'll try to remember to share it with everyone. And if you want to be reminded of things like that, appearances and interviews, jump on my email list. You can find that at marketmisbehavior.com. And I'm happy to keep you informed when I share some interesting insights away from this show. But the reason why I'm bringing that up, we talked about breadth, which has generally rotated. That's been one of the biggest shifts we've seen January, February, now March of 2026. Breadth rotating from being remarkably strong despite flat benchmarks to now looking weaker and kind of weakening here in the month of March. All right, looking at the Magnificent Seven and Friends, these mega cap leadership names. NVIDIA continuing to hold support, bouncing higher this week, up 1.2%. You've got Meta for now holding support, bouncing higher, up 1%. Amazon, Apple, both up about 1/3% or so. On the downside, we had Netflix down 1.4%, Broadcom down, Microsoft down, those both just slightly below 1%. Netflix has been kind of a rough chart for a while, but we had that bounce higher when the news of it unwinding its bid for Warner Brothers Discovery. That caused a pretty decent gap higher about a week and a half, 2 weeks ago. From there, just all these nice big up days. Just this week, we're starting to see Netflix give back some of those previous gains. I think it's a great chart as long as it holds that gap. And can't help but notice, by the way, we'll jump to this chart here for a moment. Can't help but notice we hit right to $100 a share. I mean, exactly, right? I mean, literally almost to the penny at $100, and now we're pulling back a little bit. Big round numbers have meaning, right? And I think that has been proven out. I've seen academic research that shows why big round numbers tend to see clusters of orders, why we often get reversals at big round numbers, and it has to do with how we interpret them. I would argue there's a big psychological component to that. But big round number theory has served me very well. When you have something rallying up to $100 a share, expect at least a pullback from that point. And then if we do finally get a foothold above 100, that can be a very meaningful breakout. It's like stocks. I remember Apple going above 1,000 before it's adjusted, and other names like that going over big round numbers, often pretty meaningful. All right, that's it for today's market recap. Shall we continue on and go to the heat map? I do see some great questions and comments coming in on Facebook, LinkedIn, YouTube, and X. Look like those streams are working well, and I appreciate your questions coming in and comments as well. Please keep them coming. I'll try to grab a question or two as we go. but we'll get to the heat map. We'll get to the heat map next. Ed, you ask a question here. How are these bond yields in dollar amounts and not a percent? Oh yeah, going back here. Yeah. So this is super confusing. So here's the easy version. I think we were here when I saw that question pop up. Here's a story. This is trying to, in some ways, trying to fit, a square peg in a round hole as a as a metaphor for what we're doing here. Because I remember talking to Grayson Rose and the team at Stock Charts about this market overview widget. These are a lot of these are ETFs and then some indexes, and so this is, this widget is meant to show a dollar value or an index value, a dollar change and a percent change. That makes sense for equities. That makes sense for commodity ETFs. That makes sense for crypto. It makes 0 sense for bonds and interest rates. But that was what the widget looked like. So it's kind of shoved right in here. So here's what happens, right? These look like they're dollar amounts. These are actually the indexes that are quoted from the CBOE. They run a series of indexes that track 10-year treasury yield. So it's a real-time index tracking the yield on the 10-year treasury, but it's 1 decimal point off. So 41.36 actually means 4.136%. That's the yield on the 10-year. I think the reason why it's quoted like this, I think goes back to some legacy thing because they had some product that was built off of the value of interest rates. And so they had to quote it this way on the floor. And I think it's just a legacy index related to that. But it's the best real-time data source that I know on stock charts to track 10-year treasury yields. So that's it. This part over here means absolutely no sense. So please don't think too much about it. The directional move in the yield is helpful, but a percent of a percent change makes no sense. So I would encourage you to just mentally ignore that column and don't ever look at it again. This part makes sense, which is the yield on the 10-year, just how much it's moved from one day to the next. Hopefully that answers your question there on rates. All right, let's continue on looking at the heat map. As a reminder, great visualization that helps you go kind of large to small, macro to micro. Let's start looking at some big picture observations, and then we'll go down to some sectors and groups and themes. So you saw how the S&P rotated lower in the afternoon, as did the NASDAQ. We saw how the breadth conditions were not particularly strong today, particularly with the S&P and the S&P mid-cap index. We saw how, all of the 11 S&P sectors were some flat, but most down for the day. Everything I just said, I think, makes sense when you look at the heat map here. There are some random things that were up, and we're going to take some time just kind of highlighting some of those areas of potential strength. Again, this is a one-day percent change, so let's not draw too many long-term conclusions from short-term data. The purpose of this visualization, at least how we're using it here, is to just understand what happened today and then start to connect what we see today versus the longer term. So the way that I often use this is look at the, what's happening, and then use the little preview chart, that little white chart that's popping up just as a quick glance. And then if something really interesting, you can double click and then get into the details and then analyze the chart a little bit further. But this is a great way I found to just sort of check in on what happened today. So generally, I think observation number one, obviously, more weakness than strength when we're looking across the board. The weakness in particular, let's start there. I would say localized in a number of sectors, although to be honest with you, a lot of these are showing weakness. In the technology sector, it continues to be very mixed, right? And there were periods, really I'm thinking back to like 2025, like summer of 2025, where technology was kind of like this big behemoth, about a third of the S&P, just kind of all going higher. And there were random names like Intel that weren't really looking as good as others, but generally this was a big basket of goodness going higher. Now it's really more dispersed, right? I mean, there's more of a higher dispersion. There's a higher difference between the haves and the have-nots. We're finding charts like Micron, which are arguably holding support, still great long-term charts, just kind of choppy sideways in the short term. And then you have charts like, what's a good one? CRM that have been beaten down forever and they're just starting to rotate higher. You have charts like, what's another good one? like a Seagate or Western Digital that have been remarkably strong, now potentially rotating lower. So it's really a mixed bag of different charts right about now. And I think that's important. For me, if you think about how the S&P is flat, the fact that the technology sector is flat for the day, and then you have some stocks like Micron up 3.5%. You have stocks like, AppLovin down 7+% on the same day. That shows you how the technology sector can net out to kind of a flat day, even with the top four names, right? NVIDIA and Apple slightly higher, Microsoft and Broadcom slightly lower. So it's really just sort of a mixed bag of things right about now. In terms of charts that stand out in the technology sector, Micron has to be top of mind because this is one of those that, again, is sort of a beautiful run going into the end of January and then really sideways more than anything. I'm pretty sure I grabbed that chart to dig into. Yeah, I did. So we'll save more discussion until that point. Outside of the technology sector, what else to note? So the financial sector has generally looked kind of rough here in 2026. I'm looking at you, JP Morgan, breaking down through $300 a share this month. Really, at the end of February, we were testing January, February, testing that 300 level over and over. And then this month, we're really starting to break down here. So some of those banks that had been looking really good going into 2026, it was like the moment you flip the calendar, they all started to struggle. So I'm concerned about that. Names like Visa and MasterCard also were sort of making new 3-month highs going into year end. All of those now retesting 52-week lows. Talk about a dramatic shift. The big movements today, though, are in a couple groups. One to highlight in particular, sort of the payment processors and what would I call these? Like the exchanges. They're really more data providers than anything these days, but the Intercontinental Exchange, ticker ICE, rotating lower. CBOE was one that caught my eye, making new 52-week highs at the end of February. FactSet Data Systems, FDS, has been in a downtrend for a while. PayPal, which is sort of in that group of like Square and others, or Block, that is, rotating lower as well after bouncing off of previous lows. MSCI is another one in that group. And so that group in particular is kind of rotating lower. These are sort of market data exchange types of names. Healthcare also showing some weakness here today. The healthcare sector really looking less great by the day. And charts like Johnson & Johnson stand out as positive outliers. Really good technical configuration. But for every Johnson & Johnson, I feel like there's a bunch of charts that look a lot less fantastic. I would say the biggest, most concerning rotations have been in charts like DHR. This was a chart that looked really good going into mid-January. And even I was looking through notes because we did a stock picking exercise. And I remember jotting down some of the charts that looked good. And there were a number of them that looked good back in, kind of late January that don't look anywhere near that good anymore. I mean, it's been a big shift, but look at how quickly Danaher has gone from primary uptrend, strong momentum, but not excessive momentum, moving averages all in the proper order. Everything I just said has changed, right? We've gone from above the moving averages to below them. We broke the 21-day, we broke the 50-day. Now we've broke the 200-day. The RSI going from a bullish range all above 50 to a bearish range all below 40, all below 50. In this case, even below 40. Relative strength is deteriorating. So I would argue that, technical analysis, in my experience, is not about predicting the future. It's not about knowing ahead of time that Danaher is going to be up for 3 months. It's having a consistent process of making sure that you recognize this is happening, right? We're pulling back. Okay, it's more of a pullback. Okay, it's a big drawdown. The momentum is shifting weaker. The relative strength is deteriorating. I don't think you need to pinpoint that top to benefit from the recognition that the trend has shifted. And so that's why it's really how this show started years ago in a different form, was because of my daily process of just trying to identify charts that had gone from bullish to bearish and bearish to bullish, and building a show around those observations. So Danaher, I would say, if you missed a name like this is one to go back. This is one to spend some time when the markets close and really think about what shifted. Think about what signals, what triggers would have helped you get out of that trade quickly enough, and recognize what we call a change of character. I think that's absolutely vital. So a lot of red in healthcare. It's not just That particular name. It's a bunch of them. In the industrial sector, there are things that are still holding up quite well. There are also things that are rotating down. I feel like that's the story with most of these sectors, but I'm particularly noticing some of the pullbacks that we're seeing. The one group that stood out to me was this group, not Wells Fargo, Waste Management, WM. There are a bunch of charts today that are seeing some pretty significant drawdowns. For now, we've seen a bunch of pullbacks on the way up. Waste Management, they actually do our trash here in Redmond, Washington. That's their gig. RSG is another one. Republic, which you may be served by depending on where you're located around the U.S. Basically, these are trash waste companies, and a lot of these having some pretty significant pullbacks. Waste Management made a new 52-week high earlier this month, so it's been a strong chart. It's pulling back today, which isn't good, but it's pulling back to a 21-day EMA, and the question is, does that hold? We've had a bunch of pullbacks, haven't really gotten below the 50-day moving average since breaking out in mid-November, and that's a level I would certainly be watching on a chart like WM. I think that's enough time on the old market carpet, because we have to move on to some charts that we've hand selected to highlight. I do want to give a quick shout out to our friends at Seeking Alpha. They've been great partners to Market Misbehavior, and I'm appreciative of that. You can find more information about their premium program at marketmisbehavior.com/seeking alpha, or you can scan the QR code that you see on your screen there. They have a quantitative model that I think is pretty well designed. They have a quantitative research team managed by Steve Kress, who I've interviewed on my podcast. You should go check that out on my YouTube channel if you didn't see that. It was last year at one point that I sat down with him. I should get him back on the show as I'm saying that out loud to remind myself to do so. Because I thought his approach to improving that model and maintaining that model was pretty sound. Also, just want to point out they have this thing called a health check. It's kind of like a wellness check for your portfolio. You put in your portfolio or watch list, and it literally scans through that portfolio and shows you some portfolio level analytics to help you identify some areas of potential weakness using that quantitative process. That mirrors a routine we used to do called a portfolio review with portfolio managers at Fidelity. Once a quarter, we'd run their entire portfolio. We would look at every chart of every position that they had, and we would sit down not to go through everything, but just focus on like the 5 to 10% of their holdings where we felt they needed to make a change. Seeking Alpha gives you that sort of regular review to make sure you don't miss anything. Find out more info at marketmisbehavior.com/seeking alpha. You can get 10% off if you use that link. And it helps me keep Market Misbehavior awesome. So thanks to our friends at Seeking Alpha for being awesome partners. All right, let us continue on. These are some charts that I've hand selected as I'm getting wordy here, and I apologize. There's so much happening in the markets right now. I feel like my cup runneth over of fun things to talk about. I'll try to tighten things up here, and I do see some questions I want to get to in a minute. Daily chart of the S&P, that 6,800 level is pretty important. And I think I was writing or sharing with my Market Misbehavior premium members in our weekly flight plan over the weekend. Look, the worst case scenario at this moment, and this was Friday where we closed below that 6,800 level, that pivot point, that initial line in the sand. I said, here's what could happen, right? A really bad outcome would be a big snapback rally to test that breakdown level, because that was our line in the sand level of support. If we then test that from below, and then that sets us up for the next leg down, that would be the worst case scenario. And I don't want to say that that's exactly what's happening, but it certainly felt that way today as we traded higher, but then closed back below 6,800. I think that's an important pivot point we're going to continue to monitor. The worst case scenario, obviously, is we've broken down. Very common in the technical analysis body of knowledge that you have a breakdown of support becomes resistance, and that sets us up for the next leg lower. The 200-day moving average, that 65.50 level, those are all important levels to watch if we would break down. We haven't broken down really, and really haven't followed through yet, but today closing back below 5,800, 6,800 that is not great, I would say. For the bulls, the breadth conditions to continue to deteriorate. And this has been one of the biggest shifts that we've seen from February to March, right? Look at the percent of stocks above their 50-day, which is the bottom series here. Look at how it's sitting around like 60 to 75% in January, 60 to 70% in February. All of a sudden, March starts and everything rolls over. Now, the other thing that's kind of happened, this is events in the Middle East. This is the U.S. and Israel attacking Iran, and all the sort of rumblings that have happened, all the ripple effects that have come out of that. If you think about what's changed, the breadth is getting dramatically weaker here in March, and I think that's a noticeable shift. So while the S&P has generally held its ground, a lot of things are not holding their ground, and breadth indicators come to mind immediately. We're down to 41% of S&P stocks above their 50-day, which is not, that's in a bearish range. We're down to 55% above their 200-day, which means about 15% of the S&P 500 members, that's not true, 10 to 12% it looks like, from late February to now early mid-March have broken below their 200-day moving average. That's not nothing, right? And so we're having stocks that are breaking through support. That is not the sign of a healthy bull market phase. This is a new chart I just built for today's show. I just want to show you just to highlight what we've been talking about. Here's the S&P 500, which has been generally flat. One of the really interesting nuances of the market in 2026. The S&P has been flat, but breadth has been very good. Here's the cumulative advanced decline line, which has been trending higher in January and February. At the bottom, this is the equal weighted S&P 500. And both of these are kind of closely aligned, right? They're both measures of a broader measure of performance of the benchmark as a whole. So the S&P has been flat. That's because a lot of the mega cap growth names have been struggling a bit, but the equal weighted S&P and the advanced decline line have been trending higher. What's changed sort of in March, besides the geopolitical shifts which have occurred in the Middle East and all of the speculation about what that might mean, while the S&P and the NASDAQ have not been dramatically affected, I would say the market has been affected a lot more than you might think, because look at the breadth data and how quickly it shifted. At the end of February, these are both making new all-time highs, and now they're both coming down pretty good. So while the S&P and the NASDAQ still holding ground, still testing support, the breadth is getting worse, which tells you a lot of individual stocks are struggling. It's just not enough to move the needle on the major benchmarks, but it does tell me our portfolios might be struggling if you have a lot of individual stocks in there, because a lot of stocks are sort of struggling here. By the way, I interviewed Justin Nielsen of IBD for my podcast. We sat down a couple hours ago. We'll get that edited up and hopefully out to you tomorrow morning. I was on Justin's podcast, Investing with IBD, last week. Please check that out. I have a link to it on my YouTube channel. I have a section called Interviews where you can find that. It was a really great conversation. I enjoyed talking with Justin a great deal, and it was awesome to shift the roles a little bit and have me ask him questions. He was an assistant to William O'Neill, which I actually didn't realize until we were interviewing him. He spent years working directly with Bill O'Neill, hearing and seeing how he approached the markets, asking him questions, learning from him. And it was awesome to pick his brain a bit. We talked about this particular situation where the equal weighted S&P was starting to rotate lower. So look for that episode of the Market Misbehavior podcast coming out tomorrow morning. Justin's awesome and had some really great insights for you. So that weaker equal weighted S&P is also a component of what we call new Dow theory. This is adapting Charles Dow's original work to the markets here in 2026. Here's the equal weighted S&P at the top, rotating lower in March. Here's the equal weighted NASDAQ 100, slightly lower, but not by much. We noted a bearish divergence, or what's called a bearish non-confirmation, in January and February, as the equal weighted S&P was trending higher and the equal weighted NASDAQ making a lower high. Now all of a sudden we're starting to show some weakness here. Equal weighted NASDAQ 100 breaks below its February low. All of a sudden, Dow Theory giving a big thumbs down to this market. It has not happened yet, but I think that's going to be vital. Here's the chart of Bitcoin. I promised a quick look at Bitcoin just to share some insights here. 70,000 has been a pivot point we've been talking about. Last week, we did close above 70,000, but then immediately came back below. Today, we were trading above it as we were going live here just after 5 p.m., 5:30 p.m. Eastern. Bitcoin literally right at our pivot point of 70,000. I noted the 75,000 level is kind of an important swing point. If you take the January peak around 98K, the February low around 60K, 38.2% retracement back up is right around 75,000. That is, we tested that level from below last week. That was that rally there, and then we've pulled back. So if we do get above 70,000, the 50-day and also that first Fibonacci level all around 75,000, a breakout above there would be a really bullish development for that chart. I think at that point, you can't really fight the fact that Bitcoin would be pretty constructive. Also looking at momentum to see if we get the RSI pushing above 60. Alphabet and other names, I just want to point out, we highlighted on yesterday's show these bullish engulfing patterns, these bullish outside days. Today, a lot of those names did drift higher a little bit. Some of them cooled off in the afternoon, of course, as the S&P did. No real change to that chart, right? And that's where I think you need to recognize that sometimes the daily price action is more noise than signal. I think the real signal for me would be a break below 295. That would be a key line in the sand for Alphabet. Micron is arguably one of the better charts I could cite in the technology sector right about now. There's some others that look pretty good, but Micron certainly in the semiconductor space has been one of the better ones. Yesterday, we completed a bullish engulfing pattern at the 50-day moving average. This chart is starting to look kind of like a bull flag pattern. It's not a perfect one, but it's kind of giving those vibes to me. Back here in November and December, we had a rally into what's called an ascending triangle pattern. We broke above 260, which completed that pattern and ended up accelerating as Micron got all the way up to 460 at the end of January. Now we're in another one of these consolidation patterns, breaking above that upper trend line. If that would happen through the course of this week, that could be a really bullish continuation pattern for Micron. We'll certainly watch that. Similar to Alphabet, you've got Tesla testing key support, bounced higher today, but again, that's still the active level we're going to be watching. That's around 385. I mentioned the pullback in some of the financial stocks, CBOE, as you can see, pulling below the 21-day EMA. That's not a bad chart, right? We're still making higher highs. We're still making higher lows. And that's what I wanted to note. CBOE generally has been a pretty good chart for the last 12 to 18 months. Going back to the end of 2024, it's been a pretty good chart, but it has had some of these sort of corrective moves, these sideways, really more time corrections than anything. A number of times we've had pullbacks. We've broken the 21-day. We've sometimes broken the 50-day. Once we break the 50-day and make that new low, that's held. Once the RSI has come down to 40, it is held. That's what sort of helped us remain constructive here in September and October of last year. That's what should help us remain constructive here in December of last year as all of those conditions kind of hold. That's what I'd be looking for here. The 50-day moving average, RSI around 40. Let's look if we can set a next higher low and set the table for a next advance. So 1 day down 4.5%. While that doesn't feel good, not the end of the world, but you can look at some of those previous pullbacks to get a sense of what might be what on that chart. Two other financials to finish off with here. Goldman Sachs, as we can see, pulling back toward the 200-day moving average. It's already broken a lot of key support levels. This is a chart that I'd probably be avoiding and waiting for some sign of stability. The 200-day is kind of the last line in the sand, and then there's not much below that price level going back to the April lows. The problem for Goldman Sachs is that other banks in that same group have already broken down. Here's JPM already breaking below the 200-day moving average, already breaking below the major lows to the last 3 months. The RSI already breaking below 40. So the financial sector looking more and more like a laggard, more and more like a group of stocks that are underperforming in primary downtrends from the end of 2025 to where we're at here today. All right, I do see some questions that have come on here. Someone mentioned the interview with Mike Webster. Yeah, I had Webby on the interview on the podcast last year. He also worked directly with Bill O'Neill, and it's been awesome getting some of those guys on there. I agree. The people at IBD are just genuinely nice people and also incredibly knowledgeable with great market awareness, which is something I respect a great deal. 3P Investor, thanks as always for watching, my friend. You asked, any new developments in the Hindenburg Omen? This plus widening credit spreads plus persistently high VIX. I call this a composite Keller indicator. That has me thinking. I don't have a composite Keller indicator, but I think you're putting your finger on some of the things that I personally follow very, very closely. If you ask me 3 things that have me concerned in 2026, there are way more than 3, but the Hindenburg Omen started firing in October, November of last year, kind of reset and then fired again in January and February. I see that as a big warning sign. It is a huge red flag. And again, people ask me like, well, what if you're wrong? If I'm wrong and the market rips higher from here, that's great. I can buy stocks again and be very happy with bull trends do not bother me in the least, but I have learned to be cautious, to be defensive, to recognize clear signs of shifts. And I would say the Hindenburg Omen firing a bunch of times, no new developments of that indicator. It's fired a ton so far in the last 8 weeks. And for me, I think that's pretty bearish. You've picked up on other points that we've been talking about. Widening credit spreads and a higher VIX. Those are two big shifts in the last like 6 to 8 weeks. That, along with the breadth conditions starting to weaken, while the S&P has not broken down, that's where I'm very much concerned about downtrends here. Dave, do you think the S&P going sideways is like a spring compressing or more like a top? That is a very interesting, nuanced question. That could be in a whole hour-long diatribe a soapbox moment that I could have. It very much is like a spring compressing, though, and whether that results to the upside or the downside, I'm reminded in this sort of environment where the market is sideways. John Bollinger years ago, spoke about periods of low volatility before periods of high volatility, right? That sort of calm before the storm as things narrow in, and then you end up having a big break, to one side or the other. And it certainly has felt in a lot of ways like this S&P chart has been sort of treading water, sort of holding its ground, waiting. This is called a basing pattern. Basing patterns resolve when we break above the upper boundary and break below the lower boundary. The concern I have is what we've observed over the last week is the S&P finally resolving this pattern to the downside, and that has me a bit concerned. Final question, Mr. Alexander Leonidas, fantastic handle. Where do you buy your chart print you have on the wall? Hey, thanks for noticing that. I'm a huge fan of having charts on the wall. That is a holdover from my days at Fidelity, where I was in charge of the chart room, which is a legendary space, a physical space dedicated to market history. And we had a ton of huge wall-sized paper charts. I don't have enough. My wife will not let me, devote enough real estate in our house here to big paper charts. So I have kind of poster-sized paper charts, best I can do. But those, it's a long-term chart of major U.S. indexes going back to the 1970s. Here's a chart of interest rates going back, 50 odd years or something. That chart of the 10-year yield, showing the rally in rates up into the 1980s, and then the downtrend in rates to what we've observed most recently. Those are from SRC stockcharts.com, I want to say. SRC was a firm that used to put out these blue books and green books. Everyone, back before we had charts available online, you would have to get print charts. And there were these SRC books, which stand for Securities Research Company or Corporation or something like that. There are these famous books. And if you went to like an institutional shop, like a Fidelity, we had like piles of these old blue books. And they actually produce wall-sized paper charts that I get once a year. I haven't updated these in a little while. I have them. They're actually rolled up off my left shoulder. Those are the ones that I'm getting ready to hang up here very, very soon. So at some point, I will get my act together and do it. That's it for today. Thanks so much for watching. Thanks for those of you tuning in live. I appreciate those great questions. If you're watching the replay on our YouTube channel, welcome. Thanks for watching. Please drop a question in the comments section of our YouTube channel. For Market Misbehavior, I'm Dave Keller. Have a joyful evening. And remember, it's always a good time to own good charts. Take care, folks.